Walt Disney reporting a larger than expected loss of Disney Plus subscribers last night, a 7.5% nearly decline in total subs from the previous quarter. CEO Bob Iger announcing on the call the company will hike Disney Plus's ad-free subscription price by more than 20%. Take a look at the screen real quick. Hulu will now be $17.99 per month. Disney Plus $13.99. The subscriptions essentially will cost twice as much as when the platform first debuted 4 years ago. On the call, Iger had this to say about the new plans.
The advertising marketplace for streaming is picking up. It's more healthy than the advertising marketplace for linear television. We believe in the future of advertising on our streaming platforms, both Disney Plus and Hulu, and we're obviously trying with our pricing strategy to migrate more subs to the advertiser-supported tier.
Joining us now is Ken Leon, CFRA's Equity Research Director. Ken, is this the right move for Disney to be making to try to push people in this direction?
Well, it's great to be with you, Kelly. And, certainly for operating streaming, price increases is the trend. But there's a lot of competition. Disney is not alone. It's not just Netflix, but there are other very large, significant players. So the real opportunity just with this one business is advertising revenue. So Disney's take in the third quarter was 40% were ad pay versus ad-free plans. So that's a good baseline. It's tactical. The more interesting story for Disney is where do they go with legacy franchises, and also how do they play with the future of Disney?
Right. So the subscriber attrition that they reported last quarter, do you think that's in response to higher prices? And if so, are they doing the wrong thing by continuing to double down here?
I think pricing is just following the lead of others such as Netflix. There's room. Analysts like to talk about price elasticity. It's there, but they have to have a compelling bundle, whether it be Disney Plus and Hulu, to really drive subscriber growth. And the focus of where they want investors to look at for that success is the domestic core business, which is Disney Plus as well as Hulu, which next year they're probably going to own 100% of that. It's not going to be developing markets outside the U.S.
Hey, Ken, in terms of sequencing, deal sequencing, if you will, they will be acquiring the rest of Hulu. They're going to need some cash to do that. They'll probably take on some maybe more debt to do it as well. But do you imagine that they might either sell or spin off or do something else around the linear channels beforehand?
Yeah, 100%. So we got a toe in the water with the announcement of Disney with sports gambling with Penn Entertainment. But, what's interesting here is what's going on in the Disney kingdom is all of a sudden Kevin Mayer, Tom Staggs, who were apparent heirs to Bob Iger, are now consultants. So they're going to play a role in this future of what do you do with legacy assets, whether it's going to be a spinoff or find strategic partners for broadcasting ABC and other cable channels. The opportunity really for investors is put that aside. Let's look now at the new Disney, which is parks as well as film theatrical with streaming. That's good, but I think why the stock is not up today is because a lot of investors have questions whether you're going to have the profitability of streaming as we had for decades with cable pay TV.
I mean, is that a question? I don't know if that it is a question. I mean, you look at the margins that Netflix has versus the margins that the media companies had, call it a decade ago, and you would say that they're in completely different industries even.
So if you're a shareholder activist or Nelson Peltz, you'd say you should break up the parks from the obvious TV entertainment area, streaming. And I think Bob Iger shouldn't be just thinking about those executives in entertainment, but he should be talking to Larry Culp at General Electric or Ed Breen at DuPont, because essentially for a public equity price to go higher, we have to unleash the underlying value. And streaming is not going to be as profitable as where we were before.